Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We're unpacking Northern Ireland versus Ireland income tax 2025-26, what it really means for your take-home pay today, and tying it back to the wider cost-saver ecosystem, including tools like Northern Ireland versus Ireland Income Tax Calculator 2025-26, so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Hey, welcome back to the Cost Saver podcast. Today, we're getting into something that, honestly, I think this affects way more people than you'd expect. We're talking income tax differences between Northern Ireland and the Republic of Ireland for 2025-26. And Aside is here, as always. How are you doing?
Good, good. Yeah, I'm actually kind of excited about this one, which I know sounds weird because it's tax.
Only you would say that.
But no, seriously, this is one of those topics where, look, people lose real money because they don't understand how different these two systems are, and they're right next to each other. Like, you can literally drive 20 minutes and be in a completely different tax jurisdiction.
Right. And I think most people just assume, tax is tax, a few percentage points here or there, what's the big deal? But you're saying it's more fundamental than that?
Way more fundamental. I mean, if you're near the border or doing remote work for a company on the other side, or you're weighing up a Dublin offer against a Belfast one, this isn't academic. It directly hits what lands in your bank account. On a $65,000 salary, the difference in effective tax between the two can easily exceed £4,000 a year, and that compounds every year you stay put.
Wait, £4,000 a year? That's actually a lot.
Yeah.
I mean, over 5 years, that's 20 grand. Okay, so walk me through it. Where do people actually trip up?
The biggest thing is how they handle your tax-free amount, or rather, whether you even get one. In Northern Ireland, because it's the UK system, you get a personal allowance. For 2025-26, that's £12,570. You earn up to that, zero income tax. Only income above it gets taxed.
So a decent chunk just shielded. Okay.
Exactly. But Ireland does it completely differently. There's no big tax-free allowance. Tax is applied from the very first euro you earn. What you get instead are tax credits that reduce your final bill. A typical PAY employee gets a personal tax credit and an employee tax credit. Together, that's €4,000 for 2025.
So it's kind of the opposite way around. You pay tax from the start, then get some clawed back.
That's it. And at first glance, Ireland's bands look pretty simple. 20% up to 44,000, 40% above that. You might even think, oh, that seems reasonable. But here's the thing. Income tax is only one of 3 deductions on your Irish payslip.
Oh, 3? What are the others?
Right. So this is what I call the hidden extras. In Northern Ireland, you've got income tax and then national insurance. That's it. NI contributions are 0% up to $12,570, 8% on earnings up to $50,270, and then it actually drops to 2% above that. One additional layer, and the rate goes down as you earn more.
Okay, so fairly clean.
Compared to Ireland? Yeah. In Ireland, you've got the Universal Social Charge, USC, which is this whole separate thing with its own bands. 0.5% on the first 12,012, then 2%, then 3%, then 8% on income above 70,044. And then, on top of that, you've got PRSI, pay-related social insurance, which is 4.1% for most employees.
So you've got income tax, USC, and PRSI all stacking up. I mean, I can see why people say the tax is brutal.
And that's exactly it. When someone's earning above roughly 70,000 euros, you're looking at 40% income tax, plus 8% USC, plus 4.1% PRSI. That's a marginal rate of 52% on every extra euro. Does that make sense? Like more than half of every additional euro goes to the government.
Versus Northern Ireland at the same level?
Roughly 42%. That's 40% income tax plus 2% NI. So a 10 percentage point gap on your marginal earnings.
Which is a lot. Okay, so can we put some actual numbers to this, like a real salary?
Yeah, let's do it. So take a junior professional, $30,000 in Northern Ireland, or about $35,000 in Ireland. In NI, after income tax and national insurance, you take home around $25,120. In Ireland, on $35,000, after income tax, USC, and PRSI, you're looking at roughly 30,075 euros. So at that level, they're broadly comparable, though Ireland still comes in slightly heavier as a percentage.
Right. So even at the lower end, slight edge to NI. What about mid-career, like 55,000 NI, $65,000 Ireland?
This is where it really opens up. The $55,000 earner in Northern Ireland takes home about $42,457. The $65,000 earner in Ireland takes home approximately 47,375 euros. Now, the Irish worker earns more in absolute euros, obviously higher gross, but the effective tax rate is around 23% in Northern Ireland versus roughly 27% in Ireland for equivalent tier salaries.
So the NI worker is keeping more, percentage-wise. And I'm guessing it just gets worse from there?
It does. At $100,000 in NI versus $115,000 in Ireland, the NI worker keeps just under $70,000. The Irish worker on $115,000 keeps closer to $72,000. But as a percentage of gross, the Irish worker gives up meaningfully more. And then there's a weird UK thing I should mention.
Go on.
So in the UK, once you cross $100,000, your personal allowance starts getting tapered away. You lose $1 of allowance for every $2 earned above that threshold. By the time you hit $125,140, the allowance is completely gone. And that creates this notorious 60% effective marginal rate in that band. It catches a lot of people off guard.
60%? That's actually higher than Ireland's 52% in that specific band. That's kind of ironic.
It is, yeah. It's a weird quirk, but it's a narrow band, 100,000 to 125,140, whereas Ireland's 52% kicks in from a much lower threshold and just stays there. So overall, the UK system is still more favorable for most earners, but that taper zone is a real trap if you're not expecting.
Okay, so we've got the numbers, but I always think a real example helps. You had one, didn't you, Sierra?
Yeah, so Sierra, software engineer, she was working in Dublin on 72,000 euros. After all deductions, she was taking home roughly 47,500 euros. Then she took a remote position with a Belfast-based employer for 62,000 pounds and kept her family home in Newry, which is Northern Ireland.
Right.
Now, on paper, that looks like a pay cut of nearly 14,000 gross, but her net take-home actually rose to about 45,800, which at current exchange rates is roughly 53,500 euros. So she actually took home about 6,000 more per year.
Wait, she took a pay cut and her take-home went up by 6 grand?
By 6 grand, yeah. And then, and this is the bit that really got me, you factor in her rent in Newry versus what she was paying in Dublin 6. When you put the whole picture together, her disposable income jumped by over $18,000 annually.
That's wild. 18,000 euros more in her pocket from what looked like a worse deal on paper?
Exactly. And that's a real person making a real decision. It's not hypothetical.
Which brings up cost of living, right? Because the tax is only part of the story.
Huge part. Dublin rents can be double Belfast. Childcare in Ireland is among the most expensive in the OECD. Fuel, energy, even, a pint of Guinness in Dublin costs roughly a third more than in Belfast, which, that matters to some people more than others.
It absolutely does matter, yeah.
But seriously, even if the take-home pay were identical, your spending power would be very different depending on which side of the border you're actually living.
I hadn't thought about it quite that way. So what about people who are, properly cross-border, living in one place, working in the other?
Oh, that's where it gets genuinely complex. So the UK-Ireland double taxation agreement stops you being taxed twice on the same income, which is good. but the mechanics are fiddly. You'll typically pay tax where you work, then declare it where you live and claim credit for what you've already paid.
Okay, that sounds manageable in theory.
In theory, yeah, but people trip up on, well, on all sorts of things. Not registering for self-assessment on the resident side, misunderstanding which country has primary taxing rights. And here's one that catches remote workers. If you have days where you're working from home in a different jurisdiction, that can actually shift where the tax obligation sits, even a few days.
Oh, really? That's a minefield for hybrid workers.
It really is. And honestly, since Brexit, HMRC and Revenue have become much more coordinated on data sharing. So if your remote working pattern is even slightly ambiguous, get professional advice before your first full tax year ends. Sorting it out retrospectively is, well, it's painful.
That's a really important point. Okay, so stepping back, for a straightforward employee, which system actually wins?
So broadly, low earners, under about 20,000 or 20,000 euro, it's pretty comparable with a slight NI edge. Middle earners, 30,000 to 60,000, NI clearly ahead. Higher earners, 60,000 to 100,000, NI significantly ahead. And for self-employed high earners, NI is even more attractive because Ireland has that 11% USC surcharge on self-employed income above 100,000 euros, which just stings.
So NI across the board, basically. And I feel like there's a but coming.
There is a but. Ireland does have some things going for it. Stronger statutory sick pay, more generous parental leave in some scenarios, and their pension tax relief can be extremely valuable. You get relief at your marginal rate up to age-based limits, which for higher earners can be really powerful if you max it out.
And NI has the NHS, which you don't have to pay separately for.
Right, exactly. A lot of Irish workers end up buying private health insurance on top of everything else, so that's another cost to factor in. It's just one of those things, you know?
Oh, that's actually reassuring in a way. It's not just a simple answer.
It really does. And people ask me, can I switch residency easily? And the answer is yes, you can, but you need to properly establish residency in the new country and formally close things down in the old one. Notify both HMRC and Revenue. Keep documentation, and this is important, don't assume a benefit that's tax efficient on one side works the same way on the other. Cycle to work schemes, share options, company cars, they all have subtly different rules.
Huh, fair enough. So copying your mate's tax setup across the border is a bad idea.
Fast way to overpay tax, honestly.
All right, so to kind of pull this all together for people, if someone's listening right now and they've got a decision to make, what should they actually do?
Okay, so the practical stuff. First, Northern Ireland system with the 12,570 personal allowance and single-layer national insurance generally leaves you with more take-home pay than Ireland's credit system plus USC plus PRSI. That gap widens as your income rises, especially in that 60,000 to 100,000 band where Irish marginal rates hit 52%.
Right.
Second, don't ignore cost of living. Dublin is significantly more expensive than Belfast. Rent, childcare, healthcare, the lot. A higher gross salary in Dublin doesn't automatically mean more money in your pocket once you've paid for everything.
Yep.
Third, if you're cross-border or remote working across the border, get professional advice before your first full tax year is up. Don't wait. And fourth, honestly, just run your numbers. Take 5 minutes, use a calculator before you sign anything or accept any offer. The difference between an informed choice and a rough guess can easily be thousands a year. Have I explained that clearly?
Crystal clear. And I think the Ciara example really drives it home. What looks like a worse deal on paper can actually be thousands better when you do the maths properly.
Exactly. And with Irish budget update,
Oh, that's actually reassuring in a way. It's not just a simple answer.
it really does. And people ask me, can I switch residency easily? And the answer is yes, you can, but you need to properly establish residency in the new country and formally close things down in the old one. Notify both HMRC and Revenue. Keep documentation, and this is important, don't assume a benefit that's tax efficient on one side works the same way on the other. Cycle-to-work schemes, share options, company cars, they all have subtly different rules.
Huh, fair enough. So, copying your mate's tax setup across the border is a bad idea.
Fast way to overpay tax, honestly.
All right, so to kind of pull this all together for people, if someone's listening right now and they've got a decision to make, what should they actually do?
Okay, so the practical stuff. First, Northern Ireland's system with the 12,570 personal allowance and single-layer national insurance generally leaves you with more take-home pay than Ireland's credit system plus USC plus PRSI. That gap widens as your income rises, especially in that 60,000 to 100,000 band where Irish marginal rates hit 52%.
Right.
Second, don't ignore cost of living. Dublin is significantly more expensive than Belfast. Rent, childcare, healthcare, the lot. A higher gross salary in Dublin doesn't automatically mean more money in your pocket once you've paid for everything.
Yep.
Third, if you're cross-border or remote working across the border, get professional advice before your first full tax year is up. Don't wait. And fourth, honestly, just run your numbers. Take 5 minutes, use a calculator before you sign anything or accept any offer. The difference between an informed choice and a rough guess can easily be thousands a year. Have I explained that clearly?
Crystal clear. And I think the Ciara example really drives it home. What looks like a worse deal on paper can actually be thousands better when you do the maths properly.
Exactly. And with Irish budget updates typically landing each October, it's worth checking the current position before your next salary review, too. Things shift.
Brilliant. Thank you, Assad. I feel like we've actually made tax understandable for once, which is sort of a miracle.
I'll take that. Thanks, Angela.
Quick side note, this guide connects with other cost saver blogs, especially common tax residency mistakes when moving abroad, company car versus cash allowance in the UK tax system, and comparison of tax optimizers versus traditional calculators.
Exactly. And reading those together helps you connect the dots across their household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like Northern Ireland versus Ireland Income Tax Calculator 2025-26 right after this episode.
Primary sources used here include HMRC Income Tax Rates and Personal Allowances and Money Saving Expert Tax Rates Guide, so you can verify the data yourself and stay evidence-led.
That wraps this cost saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try Northern Ireland versus Ireland Income Tax Calculator 2025-26, then read Common Tax Residency Mistakes when moving abroad and use them together to take action today.